how do you generate that extra 9-ish%?
That's what excites us, coming in and actually working.
What's the deal with tax on this one?
We're so close to filing something. We can't say anything until at least we file it.
Garrett, your website shows a yield for IYRI of 11.8%. Is that where you expect it to remain?
It is. We're really targeting around a 10 to 12% annualized distribution rate based on exposure and the volatility level of real estate, U.S. real estate can give you.
Okay. And some websites will show a lower yield than that because it's a fund that's less than a year old. So how does NEOS calculate the yield?
That's correct. So when we're looking at yield or seeing that 11.8% that you had mentioned, it's taking the last month's distribution divided by the fund's net asset value. Those other websites can just be showing the cumulative distributions for, let's just say, the 5 months that the product has been out. It's going to show 5 months worth of distributions as opposed to the forward distribution yield.
Right. Because I know some formulas on websites that just take the trailing 12 months, divide into the price, and if there's less than 12 months, the numbers don't add up. So that makes a lot of sense. This is your real estate fund. That's the theme for this one. What made you choose the index, the Dow Jones US Real Estate Capped Index, as the one for this fund?
Sure. So we wanted to give broad-based exposure to U.S. real estate. And so this index has a great diversification across sectors and industries to where nothing is more concentrated than a 12 or 13% allocation into, say, office or industrial or telecoms. And so it's a really good underlying index for diversification and broad-based exposure.
Okay. And for some context, BlackRock has a $3.5 billion fund that's also based on the index I just mentioned. The ticker for that one's IYR, and that fund yields 2.5%. Why do you think that investors are currently interested in real estate exposure?
Sure. So real estate's a great diversifier for portfolio allocations. They tend to exhibit less volatility than, say, equity investments. They're less sensitive potentially to equity drawdowns because they're really focused on the consistent income generation that real estate could provide you. And so as you think about real estate, whether that be now liquid real estate investments in your portfolio or even private investments holding buildings, multifamilies, it's always been focused really around that rental income and a kind of consistent income generation. But they are great portfolio diversifiers for those income allocations that investors are looking for.
Okay. And we're not going to get into the individual holdings in any detail, but I think viewers will be familiar with at least a few names in the top 10 largest holdings. I'll put up a slide that gives a very simplistic explanation of each of those 10. Have investors, do you think, been looking at real estate more recently as a place to hide from the tariff chaos?
So we've certainly seen that. We've seen adoption, within IYRI, but I think generally speaking, real estates have been good cornerstone investments for income allocations, especially given the equity market runs that we've seen over the last several years. This is a great way to add, a piece of allocation into your portfolio that's going to be diversifying away from, say, just core equities or even fixed income. And so we've definitely seen a strong adoption, of flows into our product, but, kind of real estate in general.
Right. And you mentioned lower volatility a moment ago. IYRI was launched January 14th, 2025, not that long ago. So we don't have much data to look at really, but over that period of roughly 5 months, as we record this, IYRI is actually slightly ahead of its index and also the S&P 500. Do you think that's because we had that correction in April?
It is. We did see real estate slightly outperform U.S. equities during those sell-offs. And I think that's primarily driven because the tariffs were more focused on obviously importing of goods, and product. And the U.S. real estate was really more focused on infrastructure, and U.S. real estate that isn't really affected by the tariffs. And so we saw lower drawdowns because of the income that the fund generates, but also just overall a little bit less price risk because they were more of a tariff-induced sell-off than it was more macroeconomic like interest rates.
Okay. And the index yields about 2.5%, but IYRI, as we mentioned earlier, is yielding more like 11%. So how do you generate that extra 9-ish%?
Sure. So we're generating that through the option overlay strategy. And real estate, although it shows a little bit less volatility than equities, still has a healthy amount of volatility to be able to generate options income. And so that supplement to get us into that kind of targeted 10 to 12% range is driven by the option overlay portfolio.
Okay. And when you say option overlay portfolio, you're specifically selling covered calls, right?
That is correct.
And I'll assume that the viewers know how covered calls work, but if they don't, we have a video that explains that. When I say we, it's one I made a while back, and it's titled "How do Covered Call ETFs Pay Such High Yields?" and that goes over that in detail. Now, I mentioned IYR a moment ago, which is BlackRock's fund. How do you think IYRI will perform compared to IYR, the fund that just follows the index?
Sure. So I think this would fall right in line with other cover call type products, whether ours or others, and that we should see outperformance in an IYRI as a covered call during those flat, down, or slightly higher market environments. When you start to see a more bullish trend within U.S. real estate, we would see that the long-only index or long-only product in this case would outperform because we're using a portion of that upside, that volatility to generate the income levels.
Okay. So it's not like alchemy where you're expecting that this is just a new and improved, higher performing version of IYR. It's different features for different funds.
That's correct. Yeah, this is income focused. So you could see that you wouldn't have the entire total return and upside if you're really looking for significant growth investments. This is supposed to be that income investment, very similar to how you pick an income investment in other areas of your portfolio versus a growth investment.
And the expense ratio is 0.68%. Do you get to keep all of that?
We do not. So that is the total expenses that an investor would pay. But then out of that, we pay licensing fees to S&P Dow Jones for access to the index. We pay all the fund's operating expenses. We obviously have business expenses, personnel expenses. So there's a lot of other fees and expenses that go into the fund and where that 68 basis points goes to.
Okay. And I noticed that BlackRock's charging 0.39%, but their fund is passive. It just follows the index. There's no active options component to that fund. But they've got $3.5 billion of assets under management. So when you multiply 0.39% times $3.5 billion, that's actually quite a lot of money. Your fund, as I record this, has $50 million under management. Let's say it goes up 10 times to $500 million. That's still a lot less than what BlackRock's making in dollar terms. Do you ever look over the fence at those passive funds and long for the simplicity of it? I mean, they don't have to actively manage anything.
No, we love what we do. We're passionate about having the income overlays, also focusing more on quantitative strategies, although we've talked a lot about how we're rules-based. We fall under that active wrapper, and that's what excites us, coming in and actually working and not just, coming in once a quarter and maybe rolling a portfolio. So grass is not greener on the other side, we don't believe.
Okay, so options are your thing. If I understand correctly, every single fund that you have at NEOS in some way or another relates to using options to make income. Is that right?
That's correct.
So on that theme of options then, which applies to this fund as much as all the other funds that you have at NEOS, let's run through the basics of the strategy for this one. How far above the market price do you set the strike price for IYRI options?
Sure. So similar to our other products, that's going to shift on a monthly basis. And that's including several factors within our investment process. But to give a sense of where this fund has been since inception, that's averaged between around 1.5% and 4.5% out of the money. And so as we look at kind of the last roll, we were around a 1.5% and 2.5%, out of the moneyness.
Okay. So if we kept an example of 2.5%, if the underlying index were to appreciate more than 2.5%, any appreciation above that would go to the option buyer, and the appreciation all the way up to 2.5% benefits the fund. Is that correct?
Yeah, that's correct.
What about time then? How far out in terms of weeks are you selling these calls?
Sure. So again, similar to our other products, we're looking in at a roughly 6 to 7 week duration. We like to sell where the options are at their full options expiration, which is that third Friday, tends to be around the third Friday of each month. And we're rolling roughly around month end. And so that's how you're getting that 6 to 7 week duration.
And it's not just one time, right? You have more than one option going at a time. You ladder them. Is that right?
Yes, that's correct. We're laddering those options out to vary the strikes so that we are helping manage the risk of that upward move within, the U.S. real estate index that we are tracking. So you're trying to manage the price appreciation alongside of that income generation.
Okay, that's a lot of moving parts. And to clarify, if the strike price is achieved, you don't actually sell the stocks, right? So can you explain what happens with these options?
That's correct. So these options have what's called a European settlement. And that European settlement means they're settled for cash and not the underlying securities. So there's no risk intra-month that the options would have our underlying REITs called away from us. We are the ones as the portfolio managers to be able to settle up the liability of the options all for cash.
Okay, so we've covered the strike price. We've covered how many weeks, fairly typical. The third variable is how many options you sell in relation to the portfolio or the overwrite level. So how do you figure out how many options you need to sell?
Yeah. So again, similar to our other products, because we do like to look at methodology somewhat similar across different asset classes, but obviously with factors unique to each one. We're currently sitting around a 70% overlay, but that varies on month to month. And so we could see anywhere from maybe a 60 to a 90% on average percentage overlay to the fund. But as we just talked about, the income generation, the out of the moneyness, and the overlay percentage, actually all three of those are tied together. And so we're viewing how all three of those can best generate the first investment objective, the income for the fund. And then second is mitigating risk, meaning we want as much upside appreciation as possible. So kind of all three of those main considerations are looked at the same time of where to set the options, percentage overlay, for the income that we can generate for investors.
Okay. Now you mentioned income is a priority, and you can kind of see that when you look at the distributions on a chart, because we've just talked about three levers that you're constantly moving depending on what the market's doing. But if you look at the distributions, they're very consistent, and that's not coincidence, right? You pull these levers to achieve that.
That's correct. So the model's trying to have that consistency of income generation. And so, of course, that's really driven on volatility. And so as long as the volatility levels stay within, pretty sizable bands, we can adjust the options and the overlay to make sure that we're keeping up with a consistent income generation for the fund.
And I think that's an important distinction, because if you look at the distributions from IYR, which just follows the index, they're not as consistent as they are for your fund. Now, we've talked about all these consistencies between this one and the other NEOS funds. The methodology follows a similar track, but there is a difference that's important that we should cover between this one and SBYI, QQQI, which are your, biggest funds. And that is when it comes to tax. So those two that I just mentioned have very good tax efficiency. What's the deal with tax on this one?
So this is going to have slightly lower tax efficiency because the real estate options we're trading won't get the same 1256 tax treatment that we've talked about before, which means that 60% of all gains are taxed at a long-term capital gains rate and 40% at a short-term. So these are going to be all categorized as short-term capital gains. However, what we do implement across all of our products, including this, is the ability for tax loss harvesting. And that tax loss harvesting is what actually allows us to take advantage of losses at certain times in the portfolio. And when you couple the potential losses with your distributable gains, those are what can help derive a return of capital designation. So converting some of that ordinary income into a return of capital, meaning It's a deferred long-term capital gains tax treatment when you sell the fund in the future.
Right. So with ordinary income, you have to pay tax as you receive it. With return of capital, you don't pay tax until you sell, if you sell. And even then, you're not paying the income rate of tax, you're paying the capital gains rate of tax, which for most people is more favorable. Is that an accurate summary?
Yep, that's perfect.
Okay, because I don't want to be a tax advisor.
Neither do I.
That's common knowledge, right? Now, that distinction of this one not generating as much tax efficiency as SPYI and QQQI, is that a function of those two funds? You're doing a index option, and this one you're selling options on an ETF.
That's correct. So we are selling what's called a flex option, and that is linked to that underlying IYR ETF. And so that is the main reason we're not getting that 1256 index option tax treatment, but we are getting the rest of the European settlement. So not called away early, cash settled. And so that's kind of like the main driving difference between a flex option versus that standard index option.
Okay. And to put it in simple terms, there will be some, you can't predict the tax treatment, obviously, because it depends on what the market does, but there'll be some return of capital for this one. So it will be more tax efficient than a fund that just issues ordinary income. But we shouldn't expect as much return of capital as for SPYI and QQQI.
Yeah, I think the easy way to try to think about the return of capital opportunity is really the underlying reference asset or index. When you see equities move significantly higher over shorter periods of times, you'll be able to capture more losses. And since real estate, shows a little bit less volatility and less price movement than equities, then there would be the same association of getting lower volatility, lower opportunity to tax loss harvest because of those very short-term, right, significant bull runs that you could see in the equity markets.
Right. So higher volatility usually leads to higher returns, or that's the reason why investors are willing to put up with higher volatility. But in this particular example, this fund is lower volatility, which a lot of investors like, but it also means that there's likely to be less tax efficiency compared to the other funds.
That is correct. Yes.
And when you talk about a loss, it's an offsetting loss, right? So when you said stocks go up, the value of the option associated with those stocks, in this case, selling a call, goes down at the same time the stock's going up, and you write off one against the other. Is that an accurate statement?
That is an accurate statement. And as we talked, part of our investment process is not right on the whole fund. So you get that continuation of the underlying exposure that goes up greater than what the liability of the options are. And so that's how you might see, taking round numbers in any case scenario, a reference asset being up 10% and maybe a covered call product being up 7 or 8. It's that extra 2 to 3% you don't participate in, which is the detraction from those short call options.
Okay. This topic can get complicated, but I appreciate you breaking it down for us. And to be clear, this isn't free money. So that IYR fund issuing 2.5% yield and yours issuing more like 11, it's not like the extra 9 is just money you're giving away to investors in exchange for nothing else. There are costs to that. So, for example, if the real estate market were to head down and these real estate companies that are in your portfolio were to decline in value, then IYRI would also decline in value. And to flip it on the other direction, if the real estate funds were to take off and appreciate rapidly, there's potential that this fund wouldn't capture all of that appreciation. So there's some benefits, and then you also have to pay on the other end as well. So I wouldn't say that, like I said before, it's not free money, it's just a different type of fund, and it's really more suited for income investors.
Yeah, that said really well, right? Back to the scenario we talked about earlier. The negative to any type of a covered call, like higher income oriented product, is you tend to not appreciate the full level of the long only version. And so you're selling away a little bit of that upside to generate that income. And so this is very much focused on, investors looking to generate more income in their portfolios as opposed to, long-term growth.
Yeah. Okay. I mentioned that because we usually get some comments like, oh, but you'll get a higher return from the S&P 500, or you could just hold it and sell it yourself. I mean, there are ways to achieve all these different objectives, but this fund is designed for investors who want a very specific thing, which is consistent income. And I should disclose that I do hold some of this fund, which I purchased a little while ago. And my take on it is that even though it's ahead of the S&P 500 so far, I think over the long term, it's unlikely to keep up with the S&P 500. But if someone wants diversification, as you mentioned earlier, and they want lower volatility and just generally want some exposure to real estate, and they want more yield than the typical real estate fund, which I would count myself in that group, then this is a fund that's definitely worth a look. Let's wrap up by looking towards the future then. What can you tell us about the pipeline for other income-related funds at NEOS?
Sure. So we recently actually just launched a gold high income product, just actually a few days ago. But on the pipeline of where we're headed, we have one or two exciting products that we're going to be filing for. I can't talk about them yet, but they've been in the research lab for well over a year. And we're looking to continue to launch those products in more diversified ways for your portfolio. So, helping espouse, more equity views and maybe more alternative, asset class views.
Oh, okay. So normally you can give us a hint, but this time you can't even give us a hint.
We're so close to filing something. We can't say anything until at least we file it. And then we can, let everyone know that here it is. Hopefully in the next 3 months, it'll be out. And so keep a lookout, and happy to be able to talk about them as soon as they're announced.
All right. Well, I tried. Now, on the gold one that you mentioned, can you just tell us what the expected yield for that one will be?
Sure. So with gold, it actually has a decent amount of implied volatility, but we'll have our first distribution coming out, in the next, couple of weeks. But it's really around that volatility level of gold. And I think a lot of people view gold as mentally a very low volatility, investment, but there's actually, a decent amount of implied volatility there to be able to help generate income on that, type of asset class.
Well, the volatility recently has been that it just keeps going up.
It is. It's had pretty historic run. I mean, a lot of macroeconomic reasons. It's had some tailwinds, but if we look shorter term in the last kind of month to 2 months, we've kind of traded sideways for a while as everybody's waiting to see what happens with, tariffs and, the Fed rate cuts. So we found a lot of people just have core long-term gold holdings, and some want to be able to generate income off of that. And so really we're just allowing investors, like always, espouse their view. If they're a gold bug and they like having exposure to that and would like to generate some income off of that, we're trying to find, institutional ways to bring those opportunities to investors.
Well, I might be a buyer for that because I've been looking for a gold fund that generates income. I did a review of a competing one recently, and it's not easy because gold by nature doesn't produce income, but of course you have your option strategy that can achieve that. So that's another fund that I guess we may be talking about in the future.
Yeah, let us know. Always happy to come on and just educate the audience on anything we have now. So again, but just trying to let investors espouse their views across, whatever asset classes and risk or income they need for their portfolios.
So do you realize you've been on this channel more than any other fund manager?
I didn't realize that. I know we've done a lot of videos, but I didn't realize I was on the most.
Yeah, I've lost count actually of how many we've done, but it is quite a few. So just to disclose, in case anyone's wondering, can you confirm that you don't pay to be on this channel?
That's correct. We do not pay to be on this channel. Just joining to have good market content and hopefully some explanations to investors on their questions.
Yep. So if anyone's wondering, the reason that Garrett appears more often than other fund managers, two things. One is NEOS just has a lot of funds that I personally have invested in and therefore have done reviews of, because it's just kind of in my strike zone. I'm looking mostly to generate 8 to 12% in the portfolio and you have a few that fit into that. And secondly, whenever I ask, you always make time and are willing to answer any question. And I can't say that of every fund manager. Some don't want to do interviews. Some, there's a long process and it's complicated. So I appreciate that you always make it easy.
Sure. Well, thank you. We appreciate the opportunity to be on and hopefully, just educate and, talk a little bit about NEOS and answer anyone's, questions that's out there.
As always, I appreciate your time and we'll wrap it up there. So once again, this was a look at NEOS's newest fund, IYRI. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.